Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LANDSTAR System INC quarterly report. LANDSTAR System Inc. offers a diverse range of businesses and services, including transportation services, truckload, less than truckload, rail intermodal, air cargo, ocean cargo, expedited ground and air delivery, heavy haul/specialized, cross-border, project cargo, and customs brokerage truck services. Dry vans, specialty vans, unsided/platform trailers, temperature-controlled vans, and containers rail intermodal services through contracts with domestic and Canadian railroads, domestic and international air and ocean services, third-party logistics and less-than-truckload services to other transportation companies' insurance services. Risk and claims management, reinsurance of independent contractors, risks customs brokerage services. The decline in LANDSTAR System Inc.'s stock price by over 28% in the past year can be attributed to several key factors. A significant contributor was a 22% year-over-year drop in earnings per share, EPS, which was exacerbated by poor third-quarter financial results, including a decrease in revenue and diluted EPS plummeting to $0.56 from $1.41 in the prior year quarter. Additionally, the company's profitability has been impacted by a persistent low rate per load environment, which is expected to continue as a short-term risk. The planned sale of its Mexican subsidiary, Landstar Metro, SAPI de CV, may also signal challenges in that market. Furthermore, analyst downgrades and price target adjustments from firms like Stifel and UBS have contributed to the stock's decline. Lastly, softness in freight demand and agent turnover issues have reshaped the risk profile for investors, making it challenging for LANDSTAR System Inc. to recover its stock price. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Revenue growth is primarily driven by the increase in revenue generated by independent commission sales agents who consistently produce over $1 million in annual revenue, as well as customer demand influenced by overall economic conditions. Additionally, an increase in frequency or severity of accidents and claims can also contribute to revenue growth. On the other hand, revenue decline is largely due to a decrease in transportation revenue, particularly in truckload van equipment and less-than-truckload modes. Furthermore, overstated revenue due to supply chain fraud matters and impairment charges for equity investments have also contributed to revenue decline. Overall, the company's revenue growth or decline is heavily influenced by its ability to attract high-performing agents, manage customer demand, and mitigate risks associated with accidents and claims. Net income and profit margins experience significant changes. The company's net income has undergone a significant transformation, increasing by 156% from -$356,000 to $1,199,000 in the same period of 2025 compared to 2024. However, this growth is largely attributed to an unfavorable development of prior year self-insured claims estimates, which had a $12.19 million adverse effect on net income. Profit margins have also declined across segments. The transportation logistics segment saw its profit margin decrease from 5.22% in 2024 to 3.33% in 2025, while the insurance segment's profit margin dropped from 0.44% to 0.29%. These declines are largely due to elevated cargo loss experience resulting from fraud and theft in the supply chain, as well as specific commercial trucking claims. Furthermore, impairment charges of $30,104,000 have also contributed to the decline in profit margins. Overall, while net income has increased, it is essential to consider the underlying factors driving these changes, which are largely negative. The company's operating cash flow status. A mixed picture, a review of the financial summary, reveals an inconsistency in the company's ability to generate positive operating cash flow. While there are instances where the company generates negative operating cash flow, page 26, it also experiences periods of positive operating cash flow, page 27. This mixed picture suggests that the company's operating cash flow status is not stable and may vary depending on the specific time period considered. The company's debt level and interest expenses have undergone significant changes. A notable decrease in debt from $6,021,000 to $724,000 was observed between December 28, 2024 and September 27, 2025. Conversely, the interest expenses increased from $2,641,000 in 2024 to $4,107,000 in 2025, indicating a substantial rise in financial obligations. Performance overview. The company's financial performance reveals mixed results across its segments. The transportation logistics segment showed a decline in revenue and operating income, indicating a downturn in this area. In contrast, the insurance segment struggled significantly, with both revenue and operating income decreasing substantially. Key takeaways: transportation logistics segment, poor performance; insurance segment, poor performance. Management is optimistic about the company's outlook, citing a focus on delivering safe transportation services to a broad range of customers. They expect revenue to vary directly with operating costs, but are managing fixed costs effectively by focusing on variable costs. The company anticipates stable loads hauled via truck, but increased revenue per load and a shift towards multimode capacity providers. With adequate cash flow, management plans to invest in new equipment and technology, fund growth, pay dividends, and complete share purchase programs. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has a history of paying dividends to its shareholders, as confirmed on page 26. Secondly, it has also implemented share buybacks, with evidence of this practice found on pages 27 and 31. And concerns about inventory buildup and supply chain disruption. There are several red flags indicating potential concerns about inventory buildup and supply chain disruption. On page 14, the company has experienced elevated cargo loss due to fraud and theft in the supply chain, which can lead to stockouts and decreased revenue. Additionally, on page 20, a decrease in revenue per load for truckload van equipment suggests that the company may be struggling to manage its inventory effectively. Furthermore, an increase in loads hauled via BCO independent contractors, page 20, could indicate inefficiencies in the supply chain. The decline in transportation revenue due to decreased demand for van and less-than-truckload services on page 23 is also a cause for concern. Finally, potential issues related to transportation logistics and insurance claims on page 21 may indicate underlying supply chain risks that need to be addressed. That concludes the financial summary for LANDSTAR System INC. Feel free to comment below, and I will be happy to answer them when possible.